So hi guys, this will be my first video on this YouTube channel. I will be conducting a stock analysis on the electric vehicle company Arcimoto, and its ticker symbol is FUV. The stock price as of me making this is $17.01. So just before we start, a little bit about the company. It's an electric vehicle company, and its main sales include a fun utility vehicle, and it also makes some rapid responses and deliverators as well. It's headquartered in Eugene, Oregon, and it's a completely US-based company right now, with all of its sales coming in the US. The company was founded in 2007, but has only made sales or any progress over the last 2 to 3 years. Scratch that. I said 1 to 2 in the video, but 2 to 3 years in real life. So the fun utility vehicles is their main source of income. It's initially designed for city needs, compact, fast charging, and it has decent luggage space as well. So this is more to do with the increased urbanization and more cities becoming more and more crowded. So this is more to address that while still having a renewable car energy source, like not using petrol instead it uses electricity. So just some news about why I have decided this. So recently it has been up 123% over the last 5 days, and this is because it has recently signed a deal with the Council of Orlando to have a fleet of FUVs reside in the city. However, the week before that, it had dropped 9% due to a less than expected Q3 earnings. Since the beginning of 2020, it's over 1,000% up. But just to keep in mind, this is a relatively new company, and it has only produced and sold 136 vehicles. The third quarter revenue, as I mentioned earlier, was $700,000 in Q3. So just the financials. So the earnings per share is negative 0.65. It has been consistently negative since 2012, 2013, where it started off as negative 0.06. The dividends are not applicable because it doesn't pay any. Understandable. It's a small company, recent startup, and it's trying to grow, not give back to its shareholders right now. The book value per share is $0.79. The stock price is $17.01. So the intrinsic value of the stock itself is quite far off from the stock price at what people are buying at, but that doesn't take into account what it's going to be in the future. The operating cash flow, free cash flow is negative $16 and $17 million respectively. This is probably because it is trying to grow, invest in itself, and is probably in debt. It is in debt right now, trying to grow, and hasn't really gotten back to things through revenue or profit. Its net margin is negative 647.5, and its return on equity is negative 122%. This is once again because it has not made any profit yet. The interest coverage is negative 16 years, which is you don't want it to be negative. But the debt to equity was surprising. I expected it to have a much higher debt to equity, but over the last few years, it's used quite a bit of its revenue to pay back on debt, and this debt is quite manageable. It's not very high, especially for a small company. So just some continued financials. The revenue is expected to go up 70% next year, based on analyst expectations. However, it does have 1 year of cash runway left, which is quite low, so it can run out of money quite fast if it doesn't live up to expectations. The company itself is currently unprofitable, and it is expected to be unprofitable at least till 2023. It will be profitable by 2024 at the earliest. It has extremely high volatility. It's been jumping up or down 10% a week sometimes, as I already mentioned, 123% up in 1 week itself, from $8 to around $17 now. The PE ratio is not applicable, as you can't have a negative amount of years, but it is negative 26. The PB ratio is 26, and the value of the company is 26 times more than all of the asset value combined, including current assets, brand value, the cars they haven't sold. So the intrinsic value is quite small compared to the stock value that people are buying it at. However, it does have a lot of room to grow in terms of revenue and profit, and it can grow very fast should things go its way. The earnings per share is also set to grow, but once again, not expected to hit positive until 2024. Uh, Another good thing about this company is that its short-term assets cover both short-term and long-term liabilities combined, and this turns back into it having a very low debt-to-equity ratio. So the economic moats of this company, I would say it has a niche market as it sells electric cars, which is niche in itself. And more than that, more specifically, it sells FUVs. However, if you look at it in the broader vehicle market itself, it might not have a niche market as there are a lot of companies selling vehicles. Um, the car the electric car industry in itself is quite niche. However, it is one of the small, like it is the underdog. There are much larger companies in this case, like Tesla or NIO, which are also selling electric cars at a much faster rate. But it does have a niche aspect compared to them, which is the SUVs. Uh, I believe it has no other economic moat as it is quite a small company, and has recently started up, so it doesn't have anything that sets it apart other than having a different product. So just a final evaluation. Financially, the company is not good, but you do need to take into consideration that it's relatively new. However, it does have the potential for exponential growth over the next coming few years, especially with this increased drive in electric vehicles. Currently, it is extremely overvalued, and I would suggest, should you looking for long-term benefit, this is not what to go for right now. There are a lot of other companies that are undervalued. However, you can invest in it if you do believe this company has the power or the drive to become game changing. As I mentioned, this company is selling something different and more versatile than a lot of other car companies, which are just selling the standard vehicle. So it does have something that sets it apart from many other competitors. However, if you just want to invest in it because it's an electric vehicle company, I would suggest to more stick with more larger, more mainstream electric vehicles like Tesla or NIO, etc. Uh, what I would suggest is keep track on this company between 2022 and 2024, because if everything has been going right for this company and it is growing then, invest in it when it starts becoming profitable, because once that happens, the stock price will start shooting through the roof, as it'll get more and more like coverage, more people will be looking to invest in it then. So that would be my take on it. Thanks for watching. I hope you guys enjoyed, and this is my first video, and I'll see you guys in the next one. Thank you.